Hello ladies and gentlemen, thank you for tuning in to Ascending Abundance YouTube channel. My name is Pavel Sverdlin. I am a CFA and a CPA, but I'm not a financial advisor, so please do your own research. In this channel, I am attempting to look at various strategies of making more money with the existing capital we got. Crypto, stocks, real estate, business, whatever comes, I'm just trying to analyze it and find that great gem in a multitude of different opportunities. So Starbucks today is the topic. It's been in the news a lot lately with their fight with the unions. I know nothing about unions. I'm not a lawyer. I don't know how fair or unfair the Starbucks labor practices are. I'm just looking at the company, its stock. I know that they're selling coffee for a lot of money. Their profit margins must be good. I know that they've been around for a while. Customers love them. They're expanding to China. And that's pretty much all I knew as of late. So I decided to take a look at the company. So as usual, just investor relations, Starbucks, you go in, choose the financial data on top, SEC filings, look at annual reports, and also let's look at the stock chart. So the stock chart is telling me that the company is not that bad. I mean, it's been going on for the last 10 years from roughly, $19-20 all the way to $96, so 5x in 10 years. Probably not a phenomenal rate of return, and if we compare this to, let's say, S&P 500, it's beaten S&P, and if we compare this to NASDAQ, it's probably going to be below. Yes, it's below S&P, so not so bad. Kind of chumming along, beating S&P 500. So I want to take a look at what's happening with this company. Looking at investor relations, pick up the 2022 annual report. We could easily on like page 2 see in the middle there financial statements and supplementary data. Click on that. You're going to come up to the income statement. Then you're going to see a couple of slides below the balance sheet. And then a couple of slides below, you're going to see the cash flow statement. So what are these numbers telling us? Interestingly enough, their equity is negative. So if somebody is using searches, this is the problem of not doing your own research. And I'm all up for financials. Just dig it in. Like really spend a little bit of time, understand what the company does. The deficit here is actually growing. Starbucks, if you look at debt to equity ratio and you want to find companies with little debt, this company will not pop up on your search engine. That is because they're buying back their stocks. They're buying back their stocks for years. They continue to buy it, and because they're spending billions and billions of dollars on retiring their equity, they're actually going into the negative. So let me go into the Excel sheet and take a look at Starbucks over the longer term. So this is 2023. This is also Q3 of 2023. So we're not looking at the full year. We're just looking at 3 quarters of 2023. So looking before that, just for the annual kind of numbers, you can see that the revenue has been steadily growing. Their net income has been not so steadily growing. That is because of 2020 when there was lockdowns and COVID and all kinds of restrictions. You kind of expect that company to lose money, but no. Even in 2020, Starbucks was making money. Not much of it, but still. 2021, huge rebound, kind of going back to the historical levels. But then in 2022, again, economy, this and that, Chinese relationships, lots going on. The income went down, but it's still at 10%, like I'm looking at net profit margin. It's still humming along, 10, 12, 13%, 14%. So not so bad. I like companies that make net income, not EBITDA, not anything else. Looking at their balance sheet, you're probably used to me, if you've seen my previous videos, you're used to me removing goodwill, because I don't believe goodwill is an actual asset. It's just a number on the balance sheet for something you overpaid for competition. I remove current liabilities from both assets and the liabilities, because I frequently see that current assets and current liabilities overlap. If you look at their balance sheet, for example, you can see the total current assets, 7 billion out of the total 27 assets. Total liability is 9 billion over the out of the 36. Sometimes it's like the biggest chunk is current assets and current liabilities. Those are current. They're gonna come. They're gonna go. Asset accounts receivable, accounts payable, inventories, short-term borrowings, like all this stuff just cancels each other out. So I try to remove it to get a cleaner picture. And obviously their equity is negative. You remove goodwill from it, becomes even more negative. So Starbucks has always been running negative debt to equity, and it does not concern me because they're not borrowing more money. They're actually spending cash to buy back their shares. That's a great strategy for most of the companies, especially if the company is kind of stagnating, it's not growing, their stocks are getting cheaper. And it's debatable if Starbucks is cheap, that's debatable, but if the number of shares is going down, that's a good sign for me. Looking at their cash flow statement, this one is probably the most important of them all. Is the company making money in excess of capital expenditures and acquisitions? So I'm looking at it, let's say full year 2022, they made $4.4 billion. To continue growing at the pace that they're growing, they have to spend money, so they spend 1.8 billion, that's fine, and then they paid 2.2 billion in dividends. That leaves us with very little cash for financial management. I mean, do you pay half of your net income or operating cash flow, not net income, you pay half of your operating cash flow in dividends, the rest is spent on your expenditures, and you basically don't have much wiggle room. But Starbucks somehow managed to still generate some cash to buy back their shares, and you can see the share count has been steadily declining. I mean, not that phenomenally lately over the last year or two, but previously it was making quite a dent in its share count. So when I look at the free cash flow, I look at the number of shares, I calculate the free cash flow per share, calculate the ratio of the price, the market price of the shares to the free cash flow that it generates to come up to this price to free cash flow ratio. Again, this is nothing new to you guys. If you've seen my previous analysis, it's the exact same thing. Price per free cash flow here is 35 as of late. However, don't forget this is Q3, so we need to kind of divide this by another 125, or I guess divide by 3 over 4. Becomes 46, so maybe we need to multiply. Never get this right. Right, so free cash flow, price to free cash flow is 26. That is actually cheaper than it's been since roughly 2021, and if we have to go back, it's 2016. So by today's price, given the cash flow the company generated in the last 4 quarters and 3 quarters, and look at it, in the 3 quarters they generated almost as much as they did in the entire 2022. So the cash generation is there. They are relatively cheap. Now their payout ratio bothers me. The dividends have been going up and up and up. So look at it. 89% of their free cash flow is paid out in dividends. 75% of free cash flow is paid on dividends. And the way I calculate it is dividend payment divided by free cash flow, and the free cash flow is basically operating minus the capital expenditures, managed acquisitions, not including dividends. So these 3 are the free cash flow minus the dividend, kind of gives you the payout ratio. Not that much, like most of their free cash flow, whatever's left from capital expenditure is paid in dividends. Too much. They've been increasing their dividends for years and years, and look, they started in 2017, 25% increase, 20%, 20%, 13, 9, almost 9, 8. So the company's been growing dividends very steadily. I don't know about you, but in the last like 5 years, I did not get an 80% increase in my, say, paycheck, or even in the last 4 or 5 years, you get what, 60%. So in the last 5 years, I definitely didn't grow my regular income by 60%. So if you're counting on Starbucks, you're getting a raise. However, you're starting at a very small base. Your base is 2.2% dividend yield, something like that. So 2% dividend yield is not exciting, but it has been growing, but I don't think it's going to continue to grow because the company is really not generating enough cash to do any kind of financial manipulation. I don't know where they're taking the money to buy back shares. Most of it is going towards dividends. Whatever is left is probably going to the buybacks, but it's not that much. So they need to stop raising dividends this aggressively. They need to either increase their operating cash flow dramatically or decline the pace of dividend increases. And then so long as they continue buying back their shares, basically the free cash flow per share is going to grow, and the payouts are going to be bigger, and the price from free cash flow is just going to continue growing, because if the company can generate their operating cash flow, it's only a bright future from there. There are issues in China, there are issues with the union, there's all kinds of other issues I'm sure I'm not covering in this quick video, but overall I'm liking Starbucks. I believe at these levels it's a buy. I really hope China is going to get out of their debt spiral with their banks and real estate. I mean, if you're looking longer term, people are still going to buy coffee. People are still paying enormous amounts for that cup of coffee. Profit margins should improve. Union debacle, I have no idea how that's going to end. I hope their fair practices are going to be improved, become fairer, or at least will match to the legislation or whatever is required. Again, not a lawyer, I'm not even following that saga. But overall, I see Starbucks kind of continuing to grow and continuing to be a relatively good investment. Not that it's much better than S&P 500, which is diversified, but if you want to play some, I don't know, some options, or you want to pick a company to diversify in that has great exposure, that's been doing decent with dividends and share buybacks, Starbucks may be the way to go. With that, thank you very much. Tune in, subscribe, hit the like button, leave me a comment. Happy to chat further. Thank you.